Alrighty. So today we're going to learn about how to become a poor man. Nah, just kidding. But we are going to talk about the poor man's covered call. So what is it? How does it compare to the normal covered call? What are the risks and whether you should be using the poor man's covered call? So first of all, what is a poor man's covered call? So let's start off with what a normal covered call position is. So a normal covered call position is just simply buying 100 shares of the underlying stock and then selling your covered call, which is a short call option. So what is the poor man's covered call? So the poor man's covered call, instead of buying 100 shares of the underlying stock, we buy a deep in the money call option, right? So this call option can have an expiration, anywhere from 3 months to 6 months or even longer, right? I personally like to buy a deep in the money call option on leaps, which is a year or longer, right? So this way I have a longer time for the trade to work out in my favor. And then we still sell a covered call. So the reason why it's called a poor man's covered call is because it is much significantly cheaper than a covered call position, right? So many people, when they start off trading the options, right, they may not have 100 shares, or rather have the capital to buy 100 shares of the underlying stock. So instead, they can use lesser money to buy the deep in the money call option. This way, you can still have a very similar position and in fact have a higher return. So let's take a look at it on the charts and see how it looks like, right? So this is the chart of Starbucks. So let's just say we're going to initiate a covered call position. So to get into a covered call position, well, first of all, we're going to buy 100 shares, right? So 100 shares at $83.59 would cost us $8,359. And then let's say we sell a covered call at the 88 strike price, right, with a DTE of 25. So we could get about $1.20 for this, all right? So $1.20 is $120 because each option has 100 shares. So let's calculate the return of this. All right. So the annualized return is just simply you take the premium which you receive, $120, you divide it by the cost of buying the 100 shares, and you divide it by the number of days for the covered call, right? Because this covered call will expire in 25 days. Then this $1.20 will be realized profit for us. So we divide it by 25 and we times 365 days. That gives us an annualized return of 20.96%. So it is not bad, right? So this is not considering the price movement, right? We haven't considered whether the price will be going down or the price will be going up, right? So this is just merely the return of this covered call on the cost of the shares. Now let's compare it with the poor man's covered call. So the poor man's covered call, instead of buying the shares, we're going to buy a deep in the money call option. So in this case, I've used the call option, which has an expiration date of 543 days left to go. So for this, we can get it for $3,995. Okay, so $3,995, you can see, is significantly lesser. In fact, it's less than half the cost of 100 shares. So next, same thing, we would sell a covered call. So assuming it's the same covered call, and then we receive $120 for it. So what is the return? So the return, similarly, we take $120, but this time we divide it by the cost of this long call option, which is only $3,995, divided by 25 days to expiration, and then we times 365 days, and this gives us a return of 43.85%. So as you can see, just from the covered call alone, we've already doubled, right, our return. Right, we have already doubled our return on the normal covered call position. So that is why the poor man's covered call is quite a popular option strategy among a lot of people, because you can get a very high return and the risk is kept, right? Your risk is less than half you would if you buy 100 shares. Okay, so what about if the stock was to go up or the stock was to go down? What is the difference between the profits and loss between the covered call and the poor man's covered call? So let's head over to my trading platform to show you the difference. So as you can see, let's take a quick look at how Starbucks is doing since the screenshot I took. So when I took the screenshot, Starbucks was around $83.58. Right now, the market has dropped a little bit lower. So let's take a look at the option chain and see how we can construct both the cover call and the poor man's cover call and compare it to each other. So the first thing I want to do, right, we go to the option chain and then we want to take a look at which is the cover call days to expiration where you want to sell it, right? So let's say I want to go at 25 days. Okay, So if I want to initiate a covered call position, it's very simple. I'll just go to the strike that I want to sell the covered call at. So let's say in this case, let's go for the 88. All right. So what I do is I will right click it. I'll say analyze buy trade because I want to analyze the risk profile. And then I click covered stock. So you can see if I click covered stock, you immediately populate this order ticket. You have 100 shares, you buy 100 shares, and then you're selling the covered call, this call option, at the strike of 88, and then it's a debit for $80.56. So that's $8,056. All right, so let's take a look at the risk profile. So you can see this is the risk profile at expiration, right? At expiration date, this is how the expiration of the covered call, this is how the graph will look like. So we have two lines down here. So this is to just indicate how much you will make or lose if the market goes down or up. So right now the current market price is where this if you can see this goal line is somewhere around here, all right, around 80.6, around there. All right, so if the stock was to go to $70, how much does it lose? All right, this is a covered call position. If it goes to $70, you can see it loses $1,056. All right, and then if it goes up to $90, it makes $744. So let's compare this to the poor man's covered call. So for the poor man's covered call, same thing, I'll find the strike which I want to sell the covered call at. All right, analyze by trade, but this time I will click the diagonal. Right, so this poor man's covered call in essence is actually just a diagonal spread because you're buying and selling two different options from two different expiration date. Now it will populate the next available option calendar date that you can go to, but in this case we don't want to use this. We want to go slightly further out, right? Generally you want to go for somewhere around 180 days or further. I like to go all the way to the furthest because I tend to see this as a longer term investment, a longer trade. So in this case, I will go for the 19 January. I'll just adjust to 19 January 24. Now, the next thing you want to do is try and see which strike that you want to actually buy. All right. So again, we want to go for the deep in the money ones, right? So we're looking for deltas that is above 80, right? The higher normally the better, but you also want to see how much you'll be paying for it, right? Ideally, I like to pay at most, or rather, yeah, ideally I want to pay at most half of what the cost of 100 shares would be. So 100 shares at this point in time will be around 8,100. So I like to pay around $4,000 for it. So around this strike 40 or strike 45 would be ideal for me. All right, so let's say we go for the 45 strike price. So I'll shift this to 45. So you can see if you were to buy the 45 long call and you sell the 88 strike price for the cover call, you only pay $37.36. So that is $3,736, right? That is less than half of what you're paying for 100 shares for the cover call position. Now, the reason why we want to go in deep in the money call is because of this number down here. So this is the extrinsic column. So extrinsic value is very important if you want to buy and sell options, right? You need to understand what is extrinsic value. So this is basically time value, and this will all go down to zero at the end of the expiration date. So as much as possible, when you're buying options, you want to buy as little extrinsic value as possible. So you can see if you go all the way far up, there are some people who are saying that you can go ahead and buy the long call option at a cheaper price, right? You can go out of the money, right? You can even go to 90 strike price and you only pay $9.20. All right, the mark is $9, so you only pay $900 to control 100 shares, roughly at this price, $81, right? But the problem is that you're actually paying mostly extrinsic value. Extrinsic value at the end of the day, it will go to zero. So just to give you an idea where the stock has to go, right? $90 is the strike price, and if you're paying $9 for it, right, it means the stock has to go up to $99 by the time this option expires, or you lose everything that you paid for, right? So you can see now it's only $81. For it to go to $99, that's almost $20. So it has to move $20 out of $80. So that's about 25% return, right? You need to move 25% for you to break even, and you haven't made money yet. So that is why I always prefer to buy a dip in the money. the call option if I'm buying an option, right? So you can see the extrinsic value is much lesser. So this way you actually do not have a huge decay, and you're paying relatively lesser. And don't forget, you're having the covered call to offset your extrinsic value. And ideally, I want to sell a covered call that can fully offset this extrinsic value in either the first covered call or in the next 1 to 2 covered calls. So if you recall, the covered call that we sold, right, or we are intending to sell, right, as an example, is 88. So this 88 we can get roughly 72 cents, right? 72 cents, and we have gotten the 45 strike. So 72 cents minus off $1.79, so that's roughly left $1.07 left. So if I can do this for another 2 times, it means I've completely removed the extrinsic value risk of this option and even eat into the intrinsic. That means if the market just goes back to where it was when I first entered this position, I still make money because of the covered call that I've sold, right? So all right, so the poor man's covered call position, let's take a look at the risk profile compared to the normal covered call position. So again, first of all, let's see again what is the loss here. So at $70, the loss is at $1,056. So let's take a look at the poor man's covered call. Now you see the poor man's covered call loss is lesser, right? The loss is only $892. But what about the profits? All right, the profits is $744. And what about the profits for the poor man's covered call? The poor man's covered call profit is lesser. So you can see the risk is lesser, the loss is lesser, but the profits is also lesser. But then let's calculate this in terms of return, right? Because we always want to see in terms of percentage wise, how does it do? So let's first start off with the covered call, and let's bring up our trusty calculator here to take a look at in terms of the profit, right? So let's say we have a profit of $744 at expiration date of the covered call. It went up to $90, right? So we take $744, we divide it by 8,056. So the return is 9.2%. All right, and let's just keep this simple. Let's not annualize it. That means we don't divide it by the days to expiration for the covered call. So this is just simply 9.2% on this profit over the cost of your stock, right? So 9.23%. Now let's take a look at the covered call, the poor man's covered call position. All right, so the poor man's covered call, we have a profit of $615. All right, let's just run it down. $615. We divide it by the cost, $3,736. So you can see we have a return of 16.46%. So with the covered call, we have 9.2%. And with the poor man's covered call, we have 16.46%. So it is a higher return on your capital. Now let's take a look at the downside, right? We also want to always take a look at our risk. So risk is very important as well. So let's see what's the risk in terms of percentage. When it comes to the poor man's covered call, so naturally it will be higher because your cost is lesser. So let's take a look. $892, we divided by the cost again, 3,736. So let's say if the stock goes down to $70, right, we lose roughly 23.8%, right? So that's quite big, right? Now let's take a look at the covered call. The covered call position. All right, let's see the loss here. So it's $1,056. Let's divide it by the cost, 8,056. So you can see the loss is slightly lesser in terms of percentage wise. So here's the takeaway for this. That means that if you want to get into a poor man's covered call position, you also want to take into account that there's a possibility that you could lose the money. So you're going to lose the money. You don't want to put all your account or all your money which you have the capital into just one position. You want to diversify and allocate them according to your risk. Alright, so let's have some takeaways for the covered call position and the poor man's covered call position, and you can decide for yourself which one is better for you. So first of all, the covered call position, it's much more expensive because we're buying 100 shares, whereas the poor man's covered call is cheaper because we're buying a long call option which is considerably lesser in cost than the 100 shares. Next, the covered call position in terms of dollars is actually higher in terms of profit, and the poor man's covered call is lower in terms of the profit. But then the risk is also higher for the covered call position, right? Because your risk is on 100 shares, whereas for this is on what you paid for the call option. So for the covered call position, we have seen that the return is actually lower, again simply because you're buying 100 shares, whereas for the poor man's covered call, your profits is on a lower cost, right, on the long call option. And the most important thing is that the covered call position actually has no expiration date. So for shares, you can hold for as long as you want. So if for some reason when you entered into the position, right, the stock goes all the way down and it takes a long time before it finally recovers and goes up, right? So in a covered call position, right, you can just hold on to the shares, right? There's no risk or any complications involved because there's no expiration date. But the poor man covered call, right? The poor man's covered call has an expiration date, so you need to keep in mind about this, because if when there's an expiration date, you ideally want the trade to work out before the long call expires, because if it expires and you're still in loss, then there's going to be some complication there because you're not sure what to do, right? Are you going to just lose the money there? Are you going to exercise the option? Are you going to roll the option? So there's much more intricacies which I'll cover in another separate video on this, but you just need to keep in mind. So which one is more suitable for you? So if you are taking more of a long-term investment approach, right, you want to hold a stock for a very long term and you don't want to bother about this expiration date, then you might just want to go simply just for the covered call position. Go for 100 shares and sell a covered call each time, right? Your return will be lower, but you don't have to worry about how long it takes for the market to go back up. Now, if you want to go more for a swing trade, maybe you want to be in the position for a shorter time, around 3 to 6 months, maybe even up to a year, right? Then a poor man's covered call position might be more suitable for you, because this way you can get a higher return through the leverage of options. You can get this at a cheaper price, a long call option. Alright guys, so that's the difference between the covered call and the poor man's covered call, and I hope this video has been helpful to you, and if it has, I'd appreciate if you give me a thumbs up and also subscribe to my channel as well. And as always, thank you for watching. I appreciate your time, and may the options favor you.